Hi, this is Matt from Speak Straight Mortgage. In this video, we're going to be talking about loan types. I created a downloadable worksheet so you can follow along and see how different loan types affect a property that you're looking at or your specific scenario. I found people learn best by doing, so instead of just explaining it, I'm going to show you so you can follow along and see the differences between FHA, VA, USDA, and conventional loans. This video is about loan types. It's going to expand upon our first lesson, which was the components of a mortgage payment. There's four main types of loans: conventional, USDA, FHA, and VA. USDA can only be used in rural areas. It's not a common loan. Not to say you couldn't potentially use it, but in VA, you have to be VA eligible. Most people know if they're VA eligible, but if you have questions about what makes you eligible or not, feel free to ask me, call me, email me. For the vast majority of people, it's either conventional or FHA. This tool will allow you to compare all four, and I'll go over all four, but for the vast majority of people, it's FHA or conventional. Assuming you are VA eligible, VA is the best loan you can get in almost all cases. So if you're eligible for VA, almost certainly you'd be using VA. There's exceptions, but I'm going to go over now why it's important to understand the differences between loan types in a few different categories. First, we're going to go over loan amount and down payment requirements for each loan. So on the same worksheet where we're on lesson 1 before, click on the bottom tab to loan types. Again, like I could switch back to the first one we just did. Now we're going back to loan types. Okay, and we're going to use the same property, $485,000 purchase price. So we entered the purchase price. Now we're picking loan type here. We're going to start with conventional. And you can see when you change it to conventional, it's going to change the options for the amount down you can put. The least you can put down on a conventional loan is 3%. If you're not a first-time home buyer, most likely you have to put down 5%. But 3%. So we're going to pick 3%. It's going to auto-calculate the down payment, and then it's going to auto-calculate the base loan amount based on that. Now, there's no additional fee on a conventional loan, because you can see there's a base loan and a total loan. That's for other loan types, because there's an upfront charge on FHA, some VA, and USDA, which we're going to go over. So one key component to look at is what down is required. When you pick conventional, it's like, let's say if I went from VA to conventional, it's going to change this list to give you options of what you can put down. So conventional starts at 3% down. And again, has no adjustment, no additional upfront charge to the loan. Okay, now we're going to go over FHA. When you have an FHA loan, you can see it says invalid now because it changed this list. 3% is not an option. 3.5 is the minimum you can put down on an FHA loan. And another key thing to see here, when I was going over base loan amount and total loan amount, see how they're different on FHA? That's because there's a 1.75% upfront fee that's added to the loan amount on all FHA loans. So again, FHA, minimum down is 3.5. Negative part is that they charge an upfront fee. It's rolled into the loan amount. You don't pay it out of pocket. It just adds to the loan. Okay, now if we go to USDA, you can see invalid again because it's going to refresh this list. You can potentially put 0 down on a USDA loan. It is an option. The main issue with USDA loans is the area you can use them. There's income limits on USDA loans. But if you were to find a house that was in a USDA eligible area you met the income guidelines and you met the debt to income ratio requirements, it's a great loan. It's just very rare for that to happen. But you can see on a USDA loan, the total loan amount again is above the base loan amount. That's because there is a 1% upfront fee that is added to the loan on all USDA loans. So again, key part of USDA loan, you can potentially put zero down. There's a 1% upfront fee that's added to the loan amount. Lastly, VA. So VA loans are awesome. Like if you're eligible for a VA loan, it's almost always what you want to do. Zero down is the minimum you can put down. But there's what they call a funding fee. Funding fee is added to the loan amount, and the amount of the funding fee depends on this column here. If you've never used a VA loan before, pick first use. It's going to put 2.15%. It's going to add 2.15% to the loan amount for VA first use with zero down. Subsequent use, that means you've already used one VA loan, and this is going to be your second time, or subsequent, third, fourth, whatever. The upfront fee is 3.3% with zero down. And if you have disability, if you're getting disability payments, you're exempt. And that's the ultimate of getting a VA loan and being exempt from funding fee. You can see that the base loan amount and the total loan amount are the same. Okay, another part about VA, you can see before when we were in subsequent use, 3.3% upfront. That's a significant amount. You can reduce that by putting 5% down. And you can see when you put 5% down and it's subsequent use, this drops to 1.5%. It's the same for first time use. If you put 5% down, it drops to 1.5. And again, if you're exempt, it doesn't count at all. If you go to 10% down, first use, let's see. First use, if you put 10% down, is 1.25 if you're at 10% or greater down. Subsequent use is the same, it's 1.25% if you're at second use or greater. You can see that's added to the loan amount. It's not an upfront cost, it just adds to the monthly payment, which is being auto-calculated down here depending on what we pick. So to summarize that section, there's FHA, VA, USDA, and conventional. Most people will be FHA or conventional. The disadvantage of FHA is that there's a 1.75% fee added to the loan amount that you don't pay up front. Generally, you could if you wanted, but almost everybody finances it into the loan. Conventional has no upfront fee and can put as little as 3% down. So if we're just counting on this section, you can see that conventional has no additional fees. FHA adds 1.75%, USDA adds 1%, and VA can range from 0% added to the loan if you're exempt to 3.3 if you're using it for the second time or more, subsequent use, and you only put zero down. So if you're just counting this category, conventional is the best, but that's not all there is to it. And we're going to go through the other factor. So when we were going into mortgage insurance, FHA charges a monthly mortgage insurance, no matter what, of between 0.5 and 0.55. So 0.5% or 0.55%, depending on how much you put down. That's not really a huge range, but you can see Like in this case, if we go back to FHA, make this an FHA loan, we start out at 3.5%. It's calculating this at $215 because if you're putting less than 5% down, that fee is 0.55. If I change this to being 5%, you can see it drop to 192 because it's now 0.5 instead of 0.55. So you get a small reduction in mortgage insurance on an FHA loan if you put more than 5% down, but if you're only putting 3.5 down, it's 0.55%, and that is regardless of credit score. If you get approved, that's what you pay in mortgage insurance. And this is where it makes sometimes better to choose FHA depending on your credit score than conventional, even though we saw before that FHA adds 1.75% to the loan amount. So conventional mortgage insurance depends on how much you're putting down and what your credit score is. Generally speaking, if your credit score is under 700, FHA is likely a better price. It's kind of a toss-up between 680 and 700, depending on how much you're putting down. If you're putting a substantial amount down, it doesn't make as much of a difference, but I'm going to show you how to calculate it. So if we're looking for conventional mortgage insurance, go to this tab that says LLPA. LLPA means loan level pricing adjustment, and MMI means monthly mortgage insurance. So the purpose of this chart is it's going to auto-populate loan amount. This first chart, disregard right now. This has to do with upfront fees that we'll get into later when we get to closing cost and points. But what I want to show is these two charts here where it says MMI costs. MMI means monthly mortgage insurance. And I divided these into two sections. One is under 80% AMI. That means under 80% AMI means area median income. And almost everybody watching this video, or at least the customers I serve, are either in Denver and Colorado Springs. 80% AMI as of 2024 in Denver is 100,400 income. That means the people on the application, if they make under 100,400, you can use the price on this chart. If they make over that, you have to use the bottom one. There isn't that huge of a difference in most cases, but I'll go over that. If you live in Colorado Springs, the income limit is 84,000 to get the discounted from the top. Okay, so now calculating what the monthly cost is for mortgage insurance, this is divided into, this chart goes into loan to value, which basically means how much are you putting down. It goes into categories. Basically, this is saying if you're putting less than 5% down. This column is saying if you're putting between 9.99 and 5%. This is saying between 14.99 and 10%, and so on. So each category has a different amount of mortgage insurance because it's assessing risk for the lender. Basically, they're allowing you to buy the house with less out of pocket, but you're buying insurance because of the amount of risk you are. And it depends a lot by credit score. So now we're going down to the chart, which before, like I was saying, depends on income level. If you're under 80% AMI, you can use this chart. And this here is credit score. And it's very important to note that mortgage lenders use mortgage model scores. So if you're looking at Credit Karma, you're not getting the right score for this. And I'm going to have another video. I'll put a card in to go to that and put it in the description of going over in detail how to get your mortgage credit score and how we can help mitigate the cost of mortgage insurance. if you're doing a conventional loan. But you can see here's the ranges of credit scores. So let's say if you had a 660 credit score and you're only putting 3% down, that's $365 a month, which is a substantial addition. And if we were to go back to loan types, FHA is only charging $192. So this is a case, if your credit score is lower, that taking a conventional loan is not the best price. It's usually FHA if your score is lower. And the reason for that is monthly mortgage insurance is significantly more when your credit score is lower. You can see this goes from $365 and anywhere in this range. It doesn't matter if you're at $679 or at $660. If you're at $679, you pay $365. If you're at $660, you pay $365. But you can see at $780, it's only $96, which is a massive discount. So credit score means everything on a conventional loan. And amount down, you can see how the amount down also influences how much you pay in mortgage insurance. So that is why it is critical that you get a lender such as myself to soft pull your credit so we get a plan to see if we can move you up one category. Like I said, as an example, if your credit score is 679, you pay $365. If it's 680, which is 1 point difference, you pay the $80+ less per month, which is a significant difference. But going back now to the loan types category. So the mortgage insurance is the same regardless of credit score in all these categories except conventional. If you're using a conventional loan, generally speaking, you'd have a credit score of 680 or above. It might be a better deal to still use FHA because it might be a better deal. There's other reasons why you might want to use conventional, but I'll go into more detail into that as we build on. But the main concept that I want to go over in this loan type screen is that the total loan amount depends on loan type, and the mortgage insurance depends on loan type. Thirdly, what I'm going to get into under the qualification video is the amount you can qualify for depends on loan type. There are cases where you might want to use FHA because you can qualify for more. You might use conventional because you can qualify for more, but that all depends on what your credit scores are and what your debts are. We're going to go into further videos. We'll go into more detail on those topics, but I just want to give you a basic overview of why you'd pick one loan type over the next based on the amount you have to put down, the amount added to the loan amount, and mortgage insurance. I hope that makes sense. Just stay tuned for the next video. We'll go more in depth in the next topic.